The stock market begins at 9 a.m. EST, with the opening bell ringing first. Before you start watching your stocks rise and fall, learn these 10 facts about the day before the markets open. While this is not financial advice, it will help you understand what you're getting into and how you may profit from it. If you need more knowledge, speak with an expert in your industry to ensure you're doing everything correctly. Here are some things you should know before the market begins today. 1. The opening bell. Although this may appear to be a foolish question, it is a good idea to find out what time and day your local stock exchange starts. If you live in London, for example, seek for companies listed on the London Stock Exchange, which opens for business at 8:00 a.m. GMT, 3:00 a.m. EST. If you live on the opposite side of the planet and work in Asia, the Tokyo Stock Exchange is your best chance, as it opens for business at 5:00 p.m. GMT plus 96:00 a.m. EST. For more information, visit Bloomberg's opening hours page. 2. News trading. If you want to get started in day trading, you need probably grasp what news trading is. Essentially, news trading is making trades based on information released during pre-market or after-hours trading. Many of these news events, in essence, can have a significant impact on how stocks and other investment instruments trade once they open on Wall Street. Because it may affect their investing plan, investors may not want everyone else to know about particular news articles until they have had time to capitalize on them. 3. Day traders. It's simple. One of the most effective strategies for private investors to make money on Wall Street is to buy a stock when it's trading cheap and sell it when it's trading high. It sounds simple, but buying cheap and selling high is more difficult than it appears, since you never know how low or high stocks will go. However, understanding what happens during a downturn can help you avoid panicking if markets fall severely. Here are 10 things that happen throughout every financial crisis, and how you may prepare for them. 4. Buy low, sell high. The usual rule is that if stocks fall in value, they are considered a favorable investment opportunity. For example, if you purchased $1,000 worth of shares for $20, then watch their value decline by half to $10, a stock split, you would have a total value of $500. Stocks can also grow more valuable over time as a result of an earnings split, or they can remain stable or increase in value as a result of an accelerated earnings split. Whatever angle you take, timing is everything. 5. Real-time quotes. A few years ago, it would have been difficult to locate a brokerage business that did not offer real-time prices for at least some of its listed equities. Most people now do, with the exception of smaller discount brokers who may only supply delayed quotes. In either case, once the investment is started, you will have rapid access to information. If you've ever gone online and read a quote that contradicts what someone on TV is saying, which happens more often than you think, it's because they're quoting different markets. MarketWatch cites the NASDAQ Stock Exchange, whereas Jim Cramer cites the New York Stock Exchange. 6. Start small. Just because you have $100,000 in savings does not mean you should invest it. Instead, start small and see how it goes. Look into low-cost mutual funds or index funds, which may be found at many brokerages. If the value of your portfolio fluctuates, but always seems to finish up greater than when you started, you're a solid investor. If it remains flat or falls, it could be an indication that investing isn't for you. In any case, don't get caught up in attempting to surpass others. Instead, consider setting long-term goals and learning as much as you can along the way. 7. Leverage up slowly. Leveraging is normally a 4-letter word in most investors' lexicon, but it isn't always a terrible thing. Leveraging your portfolio can enhance returns if you have a healthy risk appetite. For example, suppose you hold $100,000 in equities and want to increase your leverage. You'll make $10,000 if their value rises by 10%. However, if they lose 5% of their value during a volatile time, as stocks frequently do, you lose only $500 rather than $5,000 from your initial $100,000 investment. That's how leverage works. It makes losses less painful while making gains more significant. 8. Diversify with low-cost index funds. Investing in mutual funds or stocks takes more active participation than investing in bonds and money markets, although this isn't always a bad thing. While bonds are generally considered safe investments due to their consistent interest payments and fixed maturity dates, stocks can rise at a much higher rate over time and fall faster too. In general, experts advise clients to begin investing in index funds or exchange-traded funds rather than individual equities. Mutual funds are another viable alternative, particularly for long-term goals such as retirement. These all-in-one investment vehicles hold dozens or hundreds of equities simultaneously and provide instant diversification across industrial sectors. 9. Live by the motto "Sell high." But what exactly does it mean to sell high? Simply speaking, selling high is recognizing when a firm or asset is overvalued and selling it as a result. In the opposite direction, you buy low and sell high by purchasing an asset after its value has been reduced by market forces, such as stocks or natural occurrences, like gas. By attempting to pace your trade based on market momentum, you can profit from these value ups and downswings. While there are occasions when individual equities should be bought low and sold high, there is a simpler way. Purchase low-cost exchange-traded funds, ETFs, that track indices such as the S&P 500. 10. Don't let emotions take over. Everyone reacts, and often emotionally, when news breaks. This might lead to rash emotions and spur-of-the-moment decisions that you may come to regret later. Allow yourself a few minutes to think about your reaction, not simply an emotional one. Is it really that bad? How bad is it really? Will I incur financial losses? Is there anything I can do now, in 5 minutes, 20 minutes, or over time if my greatest fears are realized? And after some time for thinking, you'll be better prepared to take any action that may be required.